At 24, I was still grinding away at a regular job trying to make a living. Meanwhile, this 24-year-old was managing a $45 billion investment fund. But in a single month, July, more than half of the fund's portfolio vanished, wiping out tens of billions of dollars. So how did an AI prodigy, once celebrated across Silicon Valley, fall into crisis so quickly? A lot of people assume Leopold Aschenbrenner got burned because he was wrong about AI. But the truth is much harsher. He may have correctly predicted that massive amounts of money would flow into AI infrastructure. What nearly took him down was his own confidence when a world of algorithms collided with real money and heavy leverage. Welcome to Why Money, where economics becomes simple, interesting, and won't put you to sleep. To understand why Leopold was willing to take such enormous risks, we first need to look at his unusual journey. Born in Germany to a family of doctors, Leopold was often seen as an outsider. According to the Straits Times, he finished high school at 15 and became Columbia University's valedictorian at just 19. Leopold was never simply a trader chasing profits. He was a believer in effective altruism, an intellectual movement that became especially influential in Silicon Valley. The basic idea is that highly capable people should use their intelligence to earn or control significant resources, then use those resources to address humanity's most serious problems, including threats to civilization itself. Driven by that belief, Leopold worked at FTX's charitable foundation before the crypto empire collapsed. He later joined OpenAI's Superalignment team, a specialized research group created to solve one of AI's most important problems: how to keep future superintelligent systems under human control and aligned with human interests. In other words, how do we make sure an AI far more intelligent than us does not eventually turn against us? At OpenAI, Leopold became one of the earliest and most vocal believers that AGI, or artificial general intelligence, could arrive within this decade. AGI refers to artificial intelligence that can match or surpass humans across a broad range of intellectual tasks. To Leopold, this was no longer science fiction, but his relationship with OpenAI quickly began to break down. After a security incident at the company, Leopold warned the board that OpenAI was not sufficiently protected against industrial espionage. In April 2024, OpenAI fired him. The company said he had improperly shared internal information and denied that his security memo was the direct reason for his dismissal. Leopold told a different story. He insisted that the material he shared was not sensitive and argued that his willingness to speak out about OpenAI's security weaknesses was the real reason he was pushed out. After leaving OpenAI, Leopold published a 165-page essay that sent shockwaves through Silicon Valley. His argument was that AGI could arrive around 2027. And if that happened, computer chips, electricity, and data centers would become some of the most strategically valuable assets in the world. That essay gave him the aura of a prophet. It also helped him attract early backing from major technology figures, including the founders of Stripe and a former CEO of GitHub. With their support, he launched an investment fund called Situational Awareness. Leopold approached the market with the confidence of someone who believed he was always the smartest person in the room. His strategy was aggressive, but easy to understand. On one side, he made huge bets on companies connected to AI infrastructure, including chip makers and data center businesses such as Micron, CoreWeave, and Nebius. On the other side, he shorted traditional software and technology stocks, believing AI would put pressure on their business models and valuations. To amplify the returns from this strategy, Leopold used leverage of up to roughly 4 times his capital. Here is how leverage works. Imagine you have $1 of your own money. You borrow another $3 from major banks, giving you $4 to invest. If the portfolio rises by 25%, you make $1. That means you have doubled your original capital. But if the portfolio falls by 25%, you lose $1. your entire original investment is gone. During the first half of the year, the AI boom, new investor money, and leverage helped the fund generate a net return of 439%. At one point, its total positions had grown into the tens of billions of dollars. The frenzy surrounding AI convinced Leopold that his strategy was unbeatable, but he had forgotten one thing: Wall Street does not run on faith in algorithms, it runs on the brutal reality of money flows. In July, the market began to turn. Investors became more concerned about interest rates, while enthusiasm around technology and AI stocks started to cool. That was when both sides of Leopold's strategy began cutting against him. The AI infrastructure stocks he owned, including Nebius, Micron, and SanDisk, fell between 35% and more than 50%. At the same time, some of the software stocks he had bet against started moving higher. His portfolio was being torn apart from both directions. And with heavy leverage, these were no longer ordinary investment losses. They triggered one of Wall Street's most dangerous mechanisms, the margin call. The banks that had lent money to the fund demanded more cash or collateral. If the fund could not provide it, its assets could be liquidated. Liquidation means the bank or lender starts selling the fund's assets to recover its money when the fund no longer has enough collateral. Put simply, the fund may not want to sell, but it can still be forced to sell in order to repay its debt. Leopold tried to raise emergency capital, but he could not find enough money. News that situational awareness was in trouble quickly spread across Wall Street. Once investors realized that a heavily leveraged whale might be forced to unload its portfolio, short sellers continued betting on further declines. That added even more pressure to the stocks the fund owned. Leopold later said the fund's publicly known positions were being traded against in an extremely damaging way. By July 30th, the fund had been pushed into a position where it had to act. Situational Awareness was forced to sell most of its public equity portfolio, which was worth roughly $16 billion. Some reports describe the sale as covering nearly the entire public portfolio. The buyer that stepped in to take most of those assets was Citadel, the investment giant founded by billionaire Ken Griffin. Combined with the losses that had already occurred, the fire sale helped push the fund's portfolio down 67% in July alone. Then came the cruelest twist. In the trading session after the sale was completed, several AI infrastructure stocks connected to the fund suddenly surged. SanDisk, Bloom Energy, and CoreWeave each jumped by more than 20%. This was not the first time Citadel had appeared at exactly the moment a rival was in distress. In the past, Ken Griffin's firm bought assets from Amaranth and Sowood Capital when those funds were in crisis. Citadel also helped inject capital into Melvin Capital during the GameStop shock. That history has given Citadel a reputation as a shark circling wounded prey. But there is still no evidence that Citadel deliberately created those collapses. In other words, we do not know whether Citadel started the fire. But it is often one of the first firms to arrive once the fire has already begun. The entire crisis unfolded during the same week Leopold was preparing to get married. As wedding guests began arriving in California, he was still racing to complete the biggest forced sale of his career. Many people compared the event to Archegos 2.0, a highly concentrated fund using massive leverage, only to be hit with margin calls when the market turned against it. But unlike Archegos, situational awareness was not completely wiped out. The fund still had roughly $10 billion in assets. It eliminated its leverage, continued holding private investments, such as its stake in Anthropic, and remained up about 80% for the year because of its extraordinary gains during the first 6 months. But the crisis exposed a deeper contradiction. Before launching Situational Awareness, Leopold had almost no direct experience running an investment fund. He had worked at FTX's charitable foundation and researched AI safety at OpenAI. Those jobs were very different from managing tens of billions of dollars, controlling leverage, and responding to margin calls during a market collapse. So why were professional investors willing to hand so much money to someone barely into his 20s? Perhaps Wall Street itself became captivated by the same things that often attract ordinary investors: the reputation of an AI prodigy, a powerful network of famous supporters, and a 439% return achieved in a very short period. Expertise in technology was mistaken for expertise in risk management. This story shows that even professional investors can be driven by FOMO, short-term performance, and herd mentality. Leopold may have correctly identified one of the biggest technological trends of our time, but predicting the future of AI and keeping an investment fund alive through a market crisis are two completely different skills. Exceptional intelligence may help you see the future of technology, but overconfidence and leverage can allow Wall Street to remove you from the game in the present. Thanks for choosing to spend your time with this video when there is so much else you could be watching. If you found it useful, leave a like and subscribe for more. Thanks for watching, and I'll see you in the next one.